In this video, we will be going over the interest rates and how that affects your monthly mortgage payment, what influences interest rates, along with what even is interest rates, because a lot of people are seeing these headlines that interest rates are rising or they're decreasing, and they don't really understand what that means for them. My name is William Singh. I'm a local real agent in the Portland, Oregon area. If you have any questions whatsoever, feel free to reach out. I'll make sure to have my contact information below. Now let's dive into it. What is the interest rate? The interest rate is the lender is charging the borrower on the amount of money. So just know that this is typically the interest in the PITI, and then the principal is the amount you borrow. So what influences interest rates? Now, the Federal Reserve, or the Fed, is a large body that is able to kind of regulate these rates. Now, what they do is they will increase or decrease these depending on the circumstances. They do this primarily through the bond market. They have a couple other tools that they use, but through the bond market, they're able to raise interest rates and decrease interest rates. Now, when we're kind of thinking on this at a macro level or a macroeconomic level, when money is cheaper to borrow, it is more likely that someone will go borrow money so that way they can make investments. When money becomes more expensive or the interest rates rise, that makes it so that way it's less incentive for people to actually borrow money. So this is a great way of controlling the economy to a certain degree. And one of the things that they usually use this for is when the inflation increases dramatically. This is one of the things that they usually aim for, about 2% inflation. And when it starts to go up or lower, that's where they will use this tool for themselves to either increase rates if there's a lot of inflation, or decrease rates if there's not a lot of inflation, or there's other economic circumstances that make the market feel a little bit not as happy. For example, for pandemics, when things are uncertain, they usually decrease the interest rates so that way it incentivizes or stimulates the economy. Or if there's war or things of that nature. Sometimes this doesn't always correlate exactly, and it's very situational, but just understand this is the main way that they are able to control interest rates, and they typically will give a lot of heads up on what will happen with the interest rates, so that way the market can respond. So a lot of times you're actually able to predict or understand a lot more about what's going to be happening in the next year or so, or at least a quarter ahead to what the interest rates will be doing. What is a monthly mortgage payment? This is the principal and interest payments towards that loan. Now, note this does not include taxes and insurance. This is just towards the mortgage on the property. So also know the fact that that monthly mortgage payment will not be changing. However, the taxes and insurance will be changing over time. Now, the key factors of determining how much that monthly mortgage payment is the loan amount, which is the purchase price minus the down payment equals the loan amount. And another factor is the interest rate, how cheap it is to borrow or how expensive it is to borrow money. Now, the other part of this is the length of the loan term. Typically, you're going to see a lot more 30-year fixed loans, but there's also a variety of other different types of lengths, like 15 years. You can also have an ARM, but just kind of keep in mind that those are the primary factors of determining what your monthly mortgage payment will be. Now that we know a little bit more about the interest rate and then the mortgage payment, we'll be able to kind of dive into a little bit more about the numbers and the correlation between the two. If you found any of this content helpful, please like and subscribe. It would mean a lot. So let's dive into some examples for the actual details of what this will actually look like. And we'll dive into this with a kind of looking at interest rates at 3%, 4%, and 5%. And we're looking at a loan amount of about $500,000. Now, this is something where the loan amount is different from the purchase price. The loan amount is the purchase price minus the down payment. Now, kind of taking a look at this, we'll be able to understand a little bit more about what the differences are, or what the jumps or decreases are when we're looking in between these rates. So with this, we'll have at 3%, we have a monthly mortgage payment of about $2,108. So this does not include taxes or insurance. So again, keep that in mind when you're looking at this. But when we jump up to 4%, there's about a $280 difference, $279.06 difference. So every 1% jump, you see about a $280 payment increase. As we kind of get up to this 5%, it again jumps up about $280 up to $2,684. Now, with this, the interest rate, as it increases, you're going to be owing more or paying more over the lifetime of the loan. A lot of times you're going to be paying the interest on the loan much sooner, or you'll be paying much more of it in the beginning of the loan. And as you move much more towards the end of the loan, you're going to be paying a lot more of the principal of it. Just kind of the ratio. The monthly mortgage payment will stay the same the entire time. The ratio of what those are will change over the lifetime of the loan. Just something to kind of keep in mind. So with that, at 3%, we're at a total interest paid over the 30-year time frame for $258,000, or pretty close to $260,000. This, then when we kind of jump to that next one, it jumps about $100,000 for the 4%. And then we jump to the 5%, and then it will jump another $106,000 over the lifetime of the loan. Now, these may seem like really huge numbers, but that's over a very long period of time. So that's just something to kind of keep in mind, but also know that you can refinance. So that way you would be paying less on that loan amount. So let's say that interest rates do drop, then you're able to then refinance, and then you will be paying less. Your monthly mortgage payment will probably be less, and that will be helpful for you to save money over the long haul. Now, I'll also have a chart right here that kind of goes over, as you kind of go towards the end of the loan, you'll see how much is really going towards principal versus how much is going towards interest, and kind of give you that better understanding of what it is. Something to note is also that loans are inflation resistant. And this is because of the fact that they are locked for such a long period of time. So for example, your monthly mortgage payment will stay the same. And as inflation increases, the monthly mortgage payment does not change. So that means that the dollar is going to kind of go a little bit further, and you're going to be kind of rewarded in the sense that you'll be getting equity as things kind of increase in terms of price. So this is a great reason why I think it is a helpful investment, especially when you are in a very inflationary moment in time. Another pro tip is to have as good of credit as possible. The reason for this is that the better the credit you have, the lower the interest rate you're going to have, which means that you're going to have to be paying less. With that in mind, just know that usually around the 740 and above, you're kind of maxing out the lowest interest rate you can get. And then 700 and above, that's kind of like the second tier. So 700 to 740, and then 640 to maybe 650 up to 700 is kind of that next tier. Now, lenders will have different tiers, and you can always talk to them a little bit more about what that is. But making sure that you have a good credit score will help tremendously in saving you money. If you have any questions, feel free to reach out. I can also connect you with a lender. I primarily work in the Portland, Oregon area, but do have a network that spans the entire US, so I can certainly help you in connecting you with a person that can help you through this journey. Again, if you found any of this content helpful, it would be great for you to like and subscribe. And thanks so much for watching.